Groceries are up, rent is up, gas price is up, inflation hits us really hard. Last week, the Federal Reserve Bank announced a 75 basis point rise in interest rates, a 50% increase from what it initially predicted for June. The move comes after consumer price inflation hit an all-time high last week, reaching a new 40-year high. You may have the most influence over your wallet through the Federal Reserve, one of the most complex institutions in the world. It works like this. When the Fed wants to stimulate growth, it may lower interest rates. As a result, businesses invest and hire more. On the other hand, when inflation is high or the economy appears to be overheating, the Fed may decide to raise rates. As a result, consumers and employers will slow their financial decisions. In order to increase the price of credit throughout the economy, the Federal Reserve raises the federal funds target rate. Business loans and consumer loans become more expensive with higher interest rates, and everyone ends up paying more in interest fees. Hello guys, welcome to my channel. During today's video, we will discuss how an environment of higher interest rates will affect Americans' wallet and the economy. Number 1. Payment for mortgages, auto loans, and credit cards are going to increase as a result of the Fed rate hikes. A Fed rate increase has a more gradual effect on consumer credit, like personal loans, lines of credit, and credit cards, due to the fact that the interest rates on variable rate loans are based on benchmarks that reference the Fed funds rate. Variable rate loans are extremely sensitive to fluctuation in the federal funds rate. Interest rates on new fixed-rate loans can rise, while those on existing loans will not change. In determining their need for capital to make investments across the economy, banks and credit unions determine the federal funds rate at which they can lend to each other. The banks that borrow money at a federal funds rate then must charge a comparable rate to the people and institutions that borrow money from them. In other words, an increase in the funds rate translates down to higher rates in credit markets, mortgage markets, and any other industry that relies on financing plans to make payments. The result is higher monthly mortgage and car payments, as well as higher interest rates on outstanding credit card debt. There has already been a sharp increase in mortgage rates. From the benchmark 30-year fixed-rate mortgages in the US, interest rates jumped to 5.78% in 1 week, the largest increase in 35 years. Number 2, your investment returns can be affected by the Federal rates hike. Low borrowing rates are often a good thing for investments because they encourage risk-taking by investors trying to compensate for lackluster returns from bonds, fixed income, or certificate deposits. Stock market prices can be negatively impacted by higher market interest rates. As interest rates rise, companies face higher costs of borrowing money. In the long term, higher costs and less business could result in lower revenues and earnings for public companies, potentially affecting their growth rate and stock value. A corporation's investments in capital goods stalls when borrowing money from a bank becomes more expensive. Some companies may not be able to grow due to higher interest rates. What's more, the immediate impact on Fed rates increase is on investor psychology, or how investors feel about the market. Traders might sell stocks right after the FOMC announces a rate hike and move into more defensive investments, rather than waiting for higher rates to work their way through the entire economy. Number 3. Interest rates on saving and CDs are affected by the Fed rates hike. Although higher interest rates may be bad for credit card borrowers, they are a boon for anyone with a savings account. You will probably react oppositely to a credit card borrowers when rates increase. Savers benefit from rate hikes and take a hit when the Fed decided to cut them, due to the fact that the Fed funds rate is also used to benchmark the annual percentage yields of the deposit accounts. As the FOMC raises rates, banks increase the interest you earn on your deposit accounts. In other words, you will earn higher interest rates on savings, checking, certificates of deposit, and money market accounts. Due to much greater competition among online banks for deposits, online savings accounts usually react faster to Fed rate changes. Traditional banks tend to respond to rate increases slower, and their APYs rarely exceed 4%, even in the best times. Number 4. The Fed may affect employment. The job market is likely to be tougher. Policies of the Federal Reserve can also impact relationships between employers and their workers indirectly. Some employers choose to freeze or cut salaries instead of cutting positions. This may cause some employees to look for alternative employment. Moreover, professionals in certain industries may explore entrepreneurship if unemployment is high and economic conditions make it impossible for them to obtain quality and well-paying jobs. In addition to shrinking demand, price increases force companies to cut costs, and one of the first places they turn is to the labor force. With a looser labor market, companies are not required to keep raising prices in order to turn a profit for their investors, which can reduce inflation and increase the value of the dollar. While high rates will mean a halt to the nominal wage gains workers have enjoyed during a period of labor shortage, the increased purchasing power of the dollar should add real value to paychecks. Number 5. There will be a higher cost of the national deficit. As long as interest rates are near zero, economists tend not to worry about the federal deficit, which represents about a year and a quarter's worth of the GDP. There will be a higher amount of interest payments for the government. What's going to happen with the progress we have been making in reducing the deficits is also going to go. Because if the economy tanks and goes into recession, it means fewer taxes will be collected. The cost of interest on our national debt increases as interest rates rise. Higher interest costs ultimately mean more taxes, direct or indirect. Therefore, the steps the government is taking to combat inflation may result in a tax hike for millions of American families. To put it simply, the Fed's goal is to keep the inflation rate at 2% and the unemployment rate around 4% by raising interest rate today and in the future. In the event they can achieve that, they have succeeded in their goal of a soft landing. Despite pessimistic outlooks, a recession is still possible despite increasing economic uncertainty. All we need to do is be patient while the economy plays out. Hopefully, the Fed rate hike will benefit us all in the long run. Okay guys, thanks for watching. That is all for today. If you enjoyed my video, please drop a like button. If you like my content, please subscribe to my channel for more future videos. I will see you soon.